I have seen people spend 50 years building a fortune and then lose a startling piece of it. For one simple reason. They thought the danger in a traditional IRA was the tax rate. It usually is not. The real danger is the runway. Most people stare at a traditional IRA or a 401k and see a pile of money with their name on it. I do not see it that way. I see a partnership with a silent partner who has never contributed a dollar to the compounding and still expects to be paid first when the withdrawals begin. That silent partner is the government. The money is not fully yours yet. It is temporarily parked in your hangar with an IRS claim attached to every pre-tax dollar. Now, here is where people make the mistake that costs them real wealth. They assume the only intelligent move is to wait until retirement, wait until income falls, wait until the so-called perfect year, wait until required minimum distributions are just over the horizon, and then begin moving money from the traditional side to the Roth side. That sounds disciplined, it sounds conservative, it sounds tax-aware, and in a great many cases, it is exactly how people walk into a trap. Because the factor with the most power in a Roth conversion is not the spreadsheet glamour item most people talk about at dinner. It is not a clever threshold. It is not some fashionable rule about never converting above one bracket or always converting below another. It is not even the deduction that everybody is excited about. It is time. Time is the oxygen inside a Roth conversion. Time is what turns an ordinary tax payment into a major lifetime advantage. Time is what allows one converted dollar to become $2 or $3 or $4 of future tax-free money, and when people misjudge time, they do not lose a little. They can lose hundreds of thousands of dollars. In some cases, they lose more than $1 million in tax-free growth they will never recover. I want to explain this the way I would explain it to a family member because too many people approach Roth conversion planning like they are trying to win an argument about this year's tax return. I am not interested in this year's tax return by itself. I am interested in your lifetime after-tax wealth. That is the only scorecard that matters. Let me begin with the foundation. A Roth conversion is very simple. You move money from a traditional IRA or traditional 401k into a Roth account. The amount you move is treated as ordinary income in the year of the conversion. You pay tax. Now, in exchange, that money lives on the other side of the wall. It grows tax-free, it comes out tax-free, and, just as important, it no longer creates required minimum distributions during your lifetime. That last piece matters more than most people appreciate. A traditional retirement account is a tax deferral machine. People celebrate that machine when they are 40, 50, or 60 because deferral feels like a gift. You get a deduction, you reduce current taxes, and the account compounds. But deferral is not forgiveness. It is merely a delayed claim. And delayed claims grow teeth. The money compounds, then the tax bill compounds right along with it. What looked elegant in your working years can become a very expensive source of forced income later in life. That is why I tell people to stop looking at the balance and start looking at the future tax freight train hidden inside the balance. If you retire with a large pre-tax account and do nothing, the account continues to grow, then required minimum distributions begin. Then those distributions pile on top of Social Security. Then more of Social Security becomes taxable. Then Medicare premium surcharges become a possibility. Then a spouse dies, and the surviving spouse suddenly files single, with the same account base and much narrower brackets. Then children inherit what is left and discover that their inheritance is not a clean asset at all, but an asset loaded with deferred ordinary income tax. That is not a strategy. That is a delayed ambush. I have always preferred to pay a fair price when I still have the choice rather than an unpredictable price later when the choice is gone. Roth conversions are about buying control before control becomes expensive. Now let me show you where people go wrong. They hear about the so-called golden window. I understand why. The logic is appealing. You retire, your wages disappear. Social Security may not have started yet. Required minimum distributions have not started yet. Your taxable income may be lower than it has been in years. Therefore, those years are a sweet spot for converting. That is true. The problem is that many investors hear that truth and turn it into a universal commandment. They act as if the only intelligent year to convert is after the paycheck stops. They wait for retirement the way a man waits for perfect weather before planting a field, and then he wonders why his harvest is so small. The golden window is real. The golden window is not the whole story. If you are still working and you have room inside a sensible tax bracket and you have cash flow available to pay the tax without raiding the account itself, then beginning sooner can be dramatically more powerful than waiting for the conventional starting line. Not always, not for every family, but often enough that anybody with a meaningful pre-tax balance ought to examine it seriously instead of dismissing it on instinct. This is where the runway metaphor matters. Most people think a Roth conversion is about the tax rate at the moment of takeoff. I think about how much runway is left after takeoff. A conversion done earlier has more distance to build speed inside the Roth, more years, more market cycles, more reinvested gains, more time beyond the reach of future tax law changes, more room for a recovered market to do its work in a tax-free compartment instead of a taxable one that is the factor people underprice. If two investors each convert the same amount at the same rate, but one converts 5 years earlier, the earlier conversion has a compounding head start the later one can never catch. That is not theory, that is arithmetic. And arithmetic is merciless. The common mistake sounds harmless when you first hear it. A person says, "I will wait until I retire because my income will be lower." That sentence feels rational, but a rational sentence is not automatically a rational plan. You must ask a second question: what am I giving up by waiting? In many cases, the answer is this: you are giving up years of tax-free compounding on money that could already have crossed the bridge. That is the million-dollar mistake in slow motion. I want you to understand brackets the right way, because brackets are useful servants and dangerous masters. A lot of people talk about tax brackets as if each bracket is a moral boundary. Cross it and disaster arrives. Stay below it and wisdom prevails. That is childish. A bracket is just a price tier. It tells you what the next dollar costs if you choose to create more income, nothing more. The job is not to worship the bracket. The job is to compare today, S price to tomorrow, S likely price, and then decide which dollars ought to move now. If I can move a dollar at a tolerable price today and keep all of its future growth permanently tax-free, I am interested. If waiting means that same dollar or its larger future cousin will be forced out later at the same or higher price, while also causing secondary damage to Social Security taxation, Medicare surcharges, widow S filing status, and heirs' tax burdens, then waiting is often far more expensive than the present tax payment ever looked. This is why blanket rules are for people who want the comfort of sounding smart without the burden of doing math. I do not like rules such as never convert above a certain bracket. I do not like rules such as always wait until retirement. I do not like rules such as Roth conversions are only for wealthy people. These slogans survive because slogans are easy to remember and hard to challenge in casual conversation. Wealth, however, is not built in casual conversation. It is built by distinguishing between a phrase that sounds prudent and a decision that is actually prudent. Here are the mechanisms that really matter. The first is what I call the deferred tax shadow. Every pre-tax retirement account throws a shadow into your future. The larger the account, the larger the shadow. If the account keeps compounding and nothing is done to shrink the pre-tax balance, the shadow lengthens. It falls across your future tax brackets, your Social Security benefits, your Medicare premiums, your surviving spouse, and often your children. People see the account statement but not the shadow. That is why they are surprised later. The second mechanism is the bracket runway. When you are still working, you may already be using part of a favorable bracket. Many people assume that means the runway is full, not necessarily. Some still have meaningful room before the next bracket. If their spending is controlled and their cash flow is healthy, they may be able to use that room now instead of wasting it. A low bracket that goes unused does not roll forward and wait for you. It disappears forever at year. And a lot of investors do not understand that. Once a year is gone, that year's cheap tax room is gone with it. The third mechanism is the outside cash rule. A Roth conversion becomes much stronger when the tax is paid from assets outside the retirement account. This is easy to understand. If you convert $100,000 and then siphon part of it off to pay the tax from inside the account, fewer dollars make it into the Roth. Fewer dollars then enjoy the future tax-free growth. That weakens the engine. If instead you pay the tax from cash flow or taxable savings, the full amount can start compounding inside the Roth. It is the difference between planting a full field and planting only part of it because you ate some of the seed. The fourth mechanism is the time multiplier. This is the star of the show and the one most people miscalculate. A conversion is not just a tax event, it is the purchase of future tax-free compounding. The earlier the purchase, the greater the compounding. 5 extra years may not sound emotional, but markets do not care about emotion. 5 extra years can mean a great deal when growth is happening on a larger base and no future distribution requirements are draining the account. The fifth mechanism is what I call the widow penalty delay bomb. A married couple can often manage conversions gracefully in joint brackets. Then one spouse dies. Income may drop a little, but the tax brackets narrow sharply. The same assets, the same tax, deferred problem. And now a single return. I have seen that movie enough times to know how it ends. When people refuse to convert because they think they are being conservative, they often push the real problem into a surviving spouse's future that is not conservative. That is outsourcing pain to the person least likely to want it. Now let me give you a real-world way to think about it. Imagine a couple in their early 60s. They are still earning good salaries. They have about $1.5 million between traditional retirement accounts. They live below their means. Their house is manageable. Their annual spending is much lower than their annual earnings. In other words, they have surplus cash flow. The conventional advice says, wait, retire first, then convert maybe. But if that couple already has room inside a sensible bracket while still working, and they can pay the conversion tax from cash flow, it can be entirely rational to start now. Not because the tax bill is pleasant, it never is, but because each year they start sooner is one more year of tax-free compounding and one less year for the pre-tax balance to keep swelling into a future RMD problem. In many planning cases, the difference between starting now and starting 5 years from now is not cosmetic. It is enormous. Not because the tax law suddenly becomes magical, not because there's one secret deduction, but because the converted dollars have more runway. That is what so many people miss. They optimize for this year as visible pain and ignore the invisible pain they are leaving in the future. I want to be very clear about something. Starting early is not automatically right. If your current bracket is high and your future bracket is almost certainly lower, waiting may make perfect sense. If you do not have outside cash to pay the tax and using retirement assets would weaken the conversion badly, the answer may change. If your spending is already tight and the tax payment would force you into financial strain, the answer may change. If converting more now would trigger consequences that outweigh the benefit, the answer may change. This is why I dislike formulas repeated without context. A Roth conversion is not a religion. It is a calculation, but it is a calculation where time must be given full weight, and that is what too many people fail to do. They stare at a tax bill of $30,000 or $40,000 and feel the sting immediately. They do not feel the $1 million of future tax-free growth that never happens because they delayed. Human beings are not wired to feel opportunity cost. That is why so much wealth is lost without anybody feeling an acute moment of loss. Nobody sends you an invoice for the tax-free growth you never got. Nobody places the missing future wealth on your kitchen table and says, here is what delay cost you. It just quietly never arrives. That is how fortunes leak away. The best investors I have known are not the people who avoid every tax bill. They are the people who understand which taxes are strategic and which taxes are accidental. A strategic tax is one you willingly pay to improve the long-term position of the whole balance sheet. An accidental tax is one you pay later because you drifted there without a plan. Roth conversions, when done intelligently, are strategic taxes, unplanned RMDs, surprise Social Security taxation, RMDs surcharges and late life bracket compression are accidental taxes. I prefer strategic taxes. Another mistake people make is thinking of the Roth conversion as a single giant decision. That mentality freezes them. They imagine an all or nothing move, convert everything, convert nothing. That is not how I think. I think in slices. I think in layers. I think in annual use, it or lows at bracket room. I think in a long series of deliberate small or medium steps that keep pushing future tax problems into smaller and smaller boxes. A family may not need one heroic conversion. A family may need 6 intelligent ones. That is often how real progress is made. Take the available low bracket, use it, take the deduction while it exists, use it, take the down market when asset values are lower, but future recovery can happen in the Roth. Use it, take the surplus cash flow while you still have it. Use it, take the joint filing years before a widow. S-return compresses the brackets. Use them. The biggest retirement planning mistakes are usually failures to use a temporary advantage while it is available. That is what this whole issue comes down to. People think the trap is the Roth conversion. The trap is inertia. The trap is believing that waiting is automatically the safe choice. The trap is treating a growing pre-tax balance like it is harmless because no bill has arrived yet. The trap is paying too much attention to the visible cost of action and too little attention to the invisible cost of delay. I have said for years that the tax code rewards people who act before they are forced. The moment you are forced, the tax code has the leverage before that moment. You do. That is why the so-called golden years before required minimum distributions are useful. That is also why some people should not wait until those years begin. If you can move a meaningful amount today at an acceptable price, if you can pay the tax from outside dollars, if your future pre-tax problem is large, if your long-term exposure to RMDs and widow penalties is real, then beginning sooner may be one of the highest value financial decisions you can make. Let me speak plainly about the emotional side, because this is where people stumble. Writing a check to the government hurts. It is supposed to hurt. You are parting with cash today for a benefit you will not hold in your hand tonight. But this is not a donation. It is a purchase. You are buying freedom from future required distributions. You are buying flexibility over your future taxable income. You are buying a cleaner inheritance for your family. You are buying protection against future tax rate changes on that converted money. You are buying a larger pool of assets that can compound without a government claim attached. That is a very different thing from simply paying tax because you had no better option. And because it is a purchase, timing matters. I would much rather buy a durable asset sooner and let it work longer than buy the same asset later and then complain I paid less tax at the start. Lower costs at the entrance is not victory if the late start causes you to leave a fortune on the table. People do this all the time in investing. They brag about buying a stock $2 cheaper and then ignore the fact that they bought it 5 years later. Time overwhelms, tiny entry, price victories. The same logic often applies here. Now, there is one more point I want to make because it matters tremendously. Every Roth conversion discussion should end with your actual life, not with my enthusiasm for the concept. Do not do a Roth conversion because someone on the internet said Roth money is the best money. Do not do it because a chart looked dramatic. Do not do it because a friend told you he converted everything and feels brilliant. Do it only if the numbers support it in your case. Do it only if the tax payment does not impair your standard of living. Do it only if the trade-off is favorable over your lifetime, not just this year. Do it with an eye on brackets, Medicare, Social Security taxation, survivor status, heirs, and timing. And above all, do not wait by default. Default is expensive. Default is how people end up with giant pre-tax balances in their 70s, muttering that nobody ever explained how any of this worked. The explanation is simple. A traditional account gives you deferral. A Roth gives you control. A smart plan decides how much control is worth buying. Now, the mistake that destroys tax-free wealth is not misunderstanding the tax tables. It is misunderstanding the value of time. If I were sitting across the table from you and you had a large traditional account, I would not begin with the question, what bracket are you in today? I would begin with a harder question, how much runway do you have left and are you wasting it? Because once the years are gone, they are gone. The bracket room disappears. The temporary deductions disappear, the lower valuations disappear. The joint return disappears for one spouse. Eventually, the ability to move slowly disappears when required distributions begin. And the tax-free compounding you could have bought earlier never comes back. That is the trap. It does not look like a trap because it is built out of delay, not drama. But I have seen enough retirement plans to know that some of the biggest financial mistakes in life are made by people who thought waiting was the prudent thing to do. Sometimes it is. Sometimes it is ruinously expensive. And the difference between those two outcomes is whether you counted time as a major factor or treated it like an afterthought. If you have a meaningful pre-tax balance, stop telling yourself you will think about Roth conversions later. Later is where the bill gets larger. Later is where the runway gets shorter. Later is where control starts slipping away. The smart move is not always to convert today. The smart move is to know exactly why you are waiting if you choose to wait. Anything less than that is not a plan. It is surrender dressed up as patience.